Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
This is a chart I showed last time, if anybody had been on the webinar last time, just to break down some of the, and I'll get to really how I've delineated the environments a little bit differently, but this is kind of the environment breakdown as we look at it from a standard macro analysis, I guess, in the news type of view. And let me explain this. This shows the past two environments that we've been in, the third environment that we are in. The question is, what is the fourth environment going forward? Steve and I were chatting a bit about that. We may be in a change in the market, and of course that's the question going forward, and how do we position for the potential next environment or a continuation of the current one. The old environment, which was really during that the credit period, the boom, when everybody was fat, dumb, and happy. The dollar was falling rapidly. China was going straight up. This was before the credit crunch. Huge risk appetite period. As I said, the dollar was falling because it was funding all those global assets out there. Asset bubbles expanding everywhere. Credit flowing. Demand hot across the globe. Then we hit this little thing called the credit crunch, and we all know the story. Demand was frozen, and it still hasn't returned much. We're low, and I'll get to that in a second. Credit just, plunged, and that was the idea of the central banks panicking and getting so involved in the system, doing all the stimulus. They were really afraid that the global credit system was about to really fall into the abyss, and they had a lot of good reasons to believe that, and it was really a scary situation. The global credit system is really the core of everything we do. Interest rates and credit drive everything in our economies, so that was a scary situation, as we all know. Asset bubbles deflated. That was the risk aversion period. Risk aversion meaning money coming out of the risky assets and moving into cash, moving into safe places to hide, those types of things. And when that happened, the dollar made a big move in what's called a risk bid. When this risk money came back and hit into the deepest capital markets in the world, the U.S. Treasuries, the dollar went up. Then we moved out of this period, and China started growing as they said they would when they started stimulating their economy. Even though we've seen China grow and we've seen the emerging markets grow and we've seen a general rebound now in global economy per se, I think the industrialized world is still in trouble but is ticking up off of the bottom. Demand is still low globally, but asset markets are expanding and booming, in fact, because we have the U.S. dollar being used again as the key funding asset. The Fed, with all the quantitative easing going on, is pushing more and more dollar credit out there in the world, pumping up the asset markets. Obviously, the credit markets have healed in a very big way. We've seen risk spreads and bonds fall. And now we're in this kind of moving on to this next period where we have potentially global healing, kind of this fourth phase, and we're seeing a little change in global markets in terms of currencies. The dollar looks like, who knows, it may be trying to put in a bottom here, and we may be into another period, and I'll talk more about that as we go forward. But these are the conventional three phases, I guess, in terms of global themes that we've been in, moving into possibly a fourth phase or an extension of this. If we have an extension of this third phase, which really has used the U.S. dollar as the implicit weak dollar policy that's driven all this credit into the system to pump up global assets. If we see this continue, and at the moment, there's a good case that it will continue, the U.S. dollar probably continues down because in this scenario, the U.S. government generally is using the dollar to keep global assets afloat and try and infuse some confidence back into the global financial system. But we could see a change, and I think the change goes a lot to whether or not the U.S. economy rebounds faster than expected, and especially if it rebounds faster than its key competitor currency, the euro and the eurozone. And that I think is really even more key, as opposed to trying to guess how fast the U.S. economy can recover, if it does, so to speak. What I have down here are kind of the three paths for the U.S. dollar. The implicit weak dollar policy, which is the really, I guess you have to say, the current policy of the Fed and the Treasury at the moment. And the dollar has fallen down, 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 but again, hasn't made it a new low yet, which is an important point, even though we've seen, Steve was talking about earlier, a blow-off in gold and new highs in stocks. The second scenario is this idea of a risk bid rally in the dollar, very similar to what we saw here in the credit crunch environment. I don't think it would be the same type of risk bid in terms of dimensions, but we could see it in Greece and in Dubai are two of the things out there on the headlines at the moment that I think are leading this mini risk bid, so to speak. We've seen a fallback in emerging markets, some money coming out of risky assets, and the dollar has rebounded accordingly. But there may be more to that rebound, and it may go to growth. And that kind of goes to scenario number 3. The dollar potentially moving on some type of valuation rally, a valuation rally from two different perspectives. Number one, the dollar rallying on surprise growth in the U.S. economy. In the non-farm payroll number on Friday, we saw a massive move in the dollar, and we've seen the continuation of that move so far this week. Non-farm payrolls came in at negative 11,000. The consensus expected a loss of 130,000. So it was a huge difference and a huge surprise. And that really can change the game, because when you see that type of surprise, if the U.S. does grow faster, again, not that it has to grow as fast as it has in the past, but if it looks like it's going to grow faster than expected, it means that the Fed may move more quickly than expected, may take some of the stimulus off the table. And again, this is a relative game. If the U.S. looks like it can grow faster now than the Eurozone, then all of a sudden the Euro doesn't look as good as it did. And also if we see the U.S. growing faster than expected, then it gives the Fed some raw material, some political backup in order to start to drain some of these reserves, take some of those dollars out of the system, so you're losing dollar supply. And the expectations of rates moving higher means the dollar loses this idea that, or at least this idea that the U.S. dollar is the key carry trade currency, meaning very, very low interest rates, borrow dollars, and buy risky assets. That changes on this a potential valuation move, and the Japanese yen falls back into that category of the lowest interest rates and the carry trade currency type of thing. So that's basically the summary of, I think, of the environments we've been in, and I think it's a decent summary of the three potential scenarios here, what goes, going on with the dollar. Just to make a point, this risk bid that we've seen, this minor risk bid at the moment, is being a little bit coordinated with this idea of a valuation move in the U.S. dollar. And I'll get to that on the last slide, along with a chart of the U.S. dollar. The chart says, have we seen a bottom? And I'll make some key points on that. Okay, the environments. And I was really trying to think of a way to give you some perspective on this without getting too esoteric, and I chose to do it this way. And again, these are just frameworks for you to use going forward, possibly as you look at the global macro environment and start to tie some of the currencies to them. I broke it down into really one major category, this risk category, or two categories: risk and then special situations. The risk categories, of course, is what we just talked about: risk appetite and risk aversion. But what people don't realize, within that risk appetite category, you really have two classes of risk appetite. And unfortunately, this seems to be the only one we know about, is this idea of offshore growth. Risk appetite. Asia is the capital gains opportunity. In this cycle for so long, all we've seen is the opportunities primarily offshore. But the reality is, and again, at the moment, I'm not saying that reality is here, but there are situations in which the capital gains potential are in the U.S. Those are the major growth opportunities.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.